What happens when you push a small snowball down a hill? And what does this have to do with growing wealthy? This is the snowball effect. When you push a small snowball down a hill, it continuously picks up snow. When it reaches the bottom of the hill, it is a giant snow boulder. The snowball compounds as it travels down the hill. The bigger it gets, the more snow it packs on with each revolution. The snowball effect is a metaphor for compounding. It explains how small actions carried out over time can lead to big results. In the same way, investing in high-quality, dividend growth stocks can generate large amounts of dividend income over long periods of time. Investors looking for the best dividend growth stocks should consider the dividend aristocrats, a group of stocks in the S&P 500 with 25-plus consecutive years of dividend growth. Here's the power of compound interest. Imagine you invested $1 that compounded at 1% per day. In 5 years, your $1 would grow to over $77 million. You'd be the richest person in the world by year 7. Keep in mind that compounding is not a get-rich-quick scheme. It takes time, and lots of it. There are no investments that compound at 1% a day in the real world. The stock market has compounded wealth, adjusted for inflation, at 7% a year over the long run. At this rate, an investment in the stock market has historically doubled every 10.3 years. It takes more time to compound wealth in the real world, but that doesn't make the principles of compounding any less powerful. Take Warren Buffett as an example. Warren Buffett is worth over $80 billion. Warren Buffett's wealth comes from the tremendous benefits of the snowball effect through time. Buffett compounded his wealth through a specific type of investment. Specifically, Buffett invests in shareholder-friendly businesses with strong competitive advantages, trading at fair or better prices. And one of his quotes here, "All there is to investing is picking good stocks at good times and staying with them as long as they remain good companies." So, looking at Berkshire Hathaway's portfolio, its top 5 stocks make up 77% of the portfolio. And these 5 businesses are the core of Warren Buffett's current compounding machine. Do you know what's interesting about these 5 businesses? All 5 are well-established businesses that pay dividends. The average dividend yield of Berkshire Hathaway's top 5 stocks is 2.8%, and Warren Buffett holds a concentrated portfolio of businesses with above-average dividend yields and long histories of dividend payments to shareholders. Investing in this type of business is the surest way to benefit from the snowball effect. The good news is you don't even have to search for these businesses. There's a list of 30 businesses with 50-plus years of consecutive dividend increases called the Dividend Kings list. Nothing says long-term success like 50 or more years of paying rising dividends in a row. Coca-Cola, one of Buffett's biggest investments, is a Dividend King. There are many other well-known stocks in the Dividend Kings list, including Procter & Gamble, 3M, Johnson & Johnson. Now, you may be watching this and think, yeah, these businesses may have a history of success, but isn't there run over? Investors have wasted tremendous sums of money chasing the new hot stock. You cannot benefit from the snowball effect by investing in businesses that are unproven. Steady, dependable results lead to wealth multiplication. What would happen if you had invested in some of the most well-known Dividend Kings in 1990? The next examples that follow all had 25-plus years of consecutive dividend increases by the end of 1990. They were well-known blue-chip stocks in 1990 as well. And it didn't take a genius to buy and hold them, but the results speak for themselves. The examples of the snowball effect in action are as follows. And all examples assume dividends were reinvested. Now, Coca-Cola has compounded investor wealth at over 14% per year over the last 30 years. Coca-Cola was the largest brand in the United States in 1990 and had a 98-year operating history at the time. It was not a startup. Coca-Cola stock ended 1989 at a share price of $1.03 per share, adjusted for splits and reinvested dividends. The stock closed at $53.86 per share on December 31st, 2019. That means the stock generated annualized returns of 14% per year over the 30-year period from 1990 to 2019. Lowe's. Lowe's is the second largest home improvement store in the United States behind only the Home Depot. In 1990, Lowe's was one of the largest home improvement stores in the United States. It had a dividend history of over 25 consecutive years of increases. Even then. Investors in Lowe's 30 years ago have done very, very well. Lowe's ended 2019 trading at an adjusted price of $118.37. with an adjusted price of 9 cents to end 1989. Lowe's stock delivered compound annual returns of 27% per year over the past 30 years. This means a $1,000 investment 30 years ago would be worth just over $1.3 million to begin 2020. Procter & Gamble was just as well known in 1990 as it is today. The company has an iconic brand portfolio with names like Tide, Bounty, Gillette, and Charmin, among many others. The company was founded in 1837. In 1990, Procter & Gamble had been around for 153 years. Not exactly a young company. Still, long-term investors in Procter & Gamble have done well. Every $1 invested in Procter & Gamble at the end of 1989 became nearly $70 by the end of the year 2019. This comes to a compound annual growth rate of 15.2% a year. Colgate-Palmolive traces its history back to 1806. Both the Colgate and Palmolive brands are easily recognized. In addition to these brands, Colgate owns the Speed Stick, Soft Soap, and Hills brands. Colgate-Palmolive has paid dividends since 1893. The company has paid increasing dividends for over 50 consecutive years. In 1990, the company had a streak of 27 consecutive dividend increases. How did 1990 investors do? Every $1 invested in Colgate-Palmolive stock grew to $262 from 1990 to 2019. Colgate-Palmolive generated a compound annual growth rate of 20.6% during this 30-year period. And the last example before I get into why the snowball effect matters is Johnson & Johnson. Johnson & Johnson is currently the largest healthcare corporation in the world. The company is one of the most stable businesses in the world as well. This stability is reflected in Johnson & Johnson's long history of dividend payments to shareholders. This slow and steady business has been a boon for shareholders over the long run. Every $1 invested in Johnson & Johnson stock at the end of 1989 grew to $75.41 by the end of 2019. The company generated compound returns of 15.5% a year for shareholders during this time period. The company's low stock price volatility only adds to its appeal. Investors have historically generated excellent returns with Johnson & Johnson stock without as many gut-wrenching ups and downs as compared to other stocks. Now, what stocks will be the next snowball effect compounders? There's no need to reinvent the wheel here. Anyone holding the serial compounders that I just went over should continue to do so. For those looking to enter into new positions in snowball effect stocks should look for the following. Number 1, an above average dividend yield. Number 2, below average price to earnings ratio. Number 3, long dividend history. The biggest constraint of the three is the long dividend history. Here is the 10 highest expected total return dividend aristocrats with above market dividend yields and below market price to earnings ratios. ExxonMobil is expected to return 16.9%, People's United 15%, Chevron 15%, Walgreens 14%, AT&T 14%, AbbVie 13%, Franklin Resources 12%, General Dynamics 11%, RTX 11%, CAH, Cardinal Health 10%. Now, those 10 stocks listed best match the criteria to take advantage of the snowball effect, and snowball stocks have strong and durable competitive advantages as well. Evidence of their competitive advantages is seen by their long operating history and consistent dividend increases. Long-term investing in great businesses with shareholder-friendly managements at fair or better prices will very likely produce compound wealth gains over time. The snowball effect matters because compounding is how you can accumulate wealth. This also shows that you need two things to accumulate wealth: time and money. Whereas the time component is what truly gets you wealth, because without time, there is no compounding. It is important to understand that because of compounding, you make more money with the same or less effort. If you make money work for you, it can work harder than you ever can. Money can work 24/7 while you as a human being still need the occasional sleep. This is important because it shows that you should start investing as early as possible. The best time to start investing was 20 years ago. The second best time to start investing is right now. Hope you guys enjoyed the video. If so, feel free to comment, like, and subscribe. As always, thanks for watching. Stay safe, stock up, and I'll see you in the next video. Peace.